Hey guys, Stock Saturday, and it's all flat for me this week, which I was quite happy with, considering the market at the moment. Just sort of looking at the S&P, last sort of 2 weeks really have been sort of down a bit after sort of a little rally up. 5.86% down in the last 2 weeks. So I was flat last week and flat this week. It's sort of coming off the sort of mid-year summer highs that we had, and maybe sort of interest rates really starting to bite a little. It doesn't seem like they're going to be cutting anytime soon. Even the tech side has been sort of dropping a fair bit, sort of certainly since the top, but even just in the last couple of weeks, the Nasdaq is down 6.5%. So a little bit more than the S&P, sort of the big stocks. Google had a rough week from the looks of it, and Amazon and sort of even Apple and people like that. Tesla have been sort of really struggling. So yeah, the tech stocks have been sort of dragging down the whole market really. But yeah, I thought that was pretty nice. So a few sort of stocks just sort of keeping me up. The miners, sort of Rio Tinto and Vale and Glencore, sort of holding up reasonably well. Metal prices not looking too bad. I have sort of across the rest of the portfolio seen some small reds, sort of Stellantis down a bit. The emerging markets ETFs down a bit, similar with sort of TSMC and Broadcom slightly down, and Hymax, but yeah, nothing too much. So it's 0% overall. So earnings wise, as they always seem to come in batches, depending on the industry, it's REIT week, and Stag Industrial looking quite good. Sort of still acquired 12 buildings in the third quarter for $204 million, and sold a couple for $28 million. So net they are still adding. 97.6% occupancy on the total portfolio, 98% on the ones that are operating. Obviously still sort of buying and putting new tenants into the ones that they've bought. But yeah, looking at the numbers, obviously net profits and that sort of thing you don't tend to look at. That sort of includes depreciation and write-downs of property values and that sort of thing. It's not really the metrics for REITs. Tend to look at core FFO, funds from operations, which is 5.2% up. But again, with the dilution, you don't even look at that really. You look at per share basis, and that's up 3.5% on this quarter last year, which in the market that we're in at the moment, I thought was not too bad at all. 3% up on the 9 months compared to first 9 months of last year. So very nice. Diluted and basic both the same, and yeah, cash sort of looking okay. They're sort of buying properties all over Chicago, Dallas, Philadelphia, as they're not really sort of into the super premium areas. So yeah, they just buy all over. 12 properties in Q3, where it was only 2 in second quarter and none in the first quarter. So going on a little bit of a buying spree. And they've also bought 67 million subsequent to the quarter end. So that'll go into quarter four. So very nice. So balance sheet wise, this it will probably be a recurring theme throughout the REITs, and is sort of partly why I'm not really looking to particularly pile into them at the moment with the high interest rates really. So they're down from 25 million in cash to 11 million. And the debts, credit facility is up to 325 million. Unsecured term loans 1 billion, and notes down a little bit, down 100 million, but 1.195 billion. With 11 million in cash, it's not really a a position I sort of like any company to be in, but it's just seems to be the way with REITs. They sort of highly levered, highly indebted, and they just issue sort of new stock from time to time, sometimes debt. But yeah, as long as it's in some sort of healthy ratio to the buildings, and the buildings are occupied and they're paying their rent, then everything's fine. But it's not something that I want to be sort of piling into, even if it is the bottom. So with sort of interest rates potentially coming down next year, it's only potentially coming down next year. So yeah, I'm happy enough with what I've got, but I'm not adding. Interest rate wise, yeah, they're sort of always had their debts on a reasonably long term. So last year was only 21 million, and this is 23 million. So it's not rocketing up with the higher rates, but if you hold all this debt long enough, it will be going up. On the 9 months, it was 56 million up to 69 million. So yeah, it is going up, and it will be going up next year if rates stay where they are, which it looks like they are. So then VICI reported. They don't give you quite as nice a sort of little table of the numbers as Stag do, but they sort of giving you the highlights. Revenues up 20.3%, but they're doing a hell of a lot of dilution and borrowing, so don't really come into that too much. But AFFO, adjusted funds from operations per share, increased 10.7%, so that's good. The dilution and debt appears to be worth it still. Weighted average shares increased 5% year over year, so they're still diluting. Sort of reasonable valuation to be diluting. It's not as if the stock's at rock bottom and they're sort of heavily diluting. So that's not too bad. Quarterly dividend, I don't really pay too much attention to the dividend. That just sort of comes in as it is. I just want to know that they're safe and still occupied and still doing well. So increased AFFO guidance is now $2.14 to $2.15 for the year, where that was sort of more $2.11. So that's quite good. They're expanding into some interesting areas as well. Completed the Rocky Gap Casino Resort acquisition, and that's sort of gaming properties in Canada. So not just getting out of Las Vegas, but getting out of America as well. Or not getting out, but expanding outside into Canada, which I thought was quite nice. Bit of diversification. And expanded their partnership with Canyon Ranch, more properties. And an interesting one subsequent to the quarter end, so none of this is in any of the figures. They bought 38 bowling alleys, or bowling entertainment centres, already leased out with Bowlero. So I guess looks like they've bought the assets from Bowlero and are leasing it back to them. So that's quite nice. 38 bowling alleys though for it was looking like $433 million. So that's quite a big acquisition, and diversifying sort of away from casinos. Still in the, I guess you'd call it, the gaming entertainment sort of sector. And yeah, just a nice bit of diversification. They have talked about other things, outside of casinos. CEO did mention even centre parks in the UK that he finds quite attractive, but whether that would sort of come to pass, or whether they'd be looking at, theme parks or that sort of thing. Interesting, but he said there's plenty of growth opportunities. So. And they have been diluting, as I say, shares up about 5%, and the debt still doesn't look sort of too bad. They got a little bit expiring in 2024, about $1 billion, so that's already at 5.6%, so that'll be going up a bit, but not sort of horrendous. Not like it's 2% or 1% debt expiring, because they've never had a sort of super good investment grade credit rating. So yeah, that'll be going up, but total debt 17.1 billion. That is rather a lot. Yeah, guidance, they were saying, sort of has increased. The adjusted funds from operations up from between 211 and 214 to 214 to 215. So that's all good. And just sort of quickly looking at the balance sheet. Again, similar to Stag, cash is up instead of down, but it's 510 million. Properties sort of obviously way up with all of their acquisitions and everything, but debt is up from 13.7 to 16.7 billion nearly, with $500 million in cash. So it's as long as the tenants are all there and they're all paying, then everything's fine. But this can sort of I wouldn't say fall apart, but they can run into trouble sort of very quickly if there are issues. So at sort of these interest rates, certainly, and with these sort of debt levels, it's not something that I want to pile into just yet. So interest, as they say, has increased 170 million, 169 million last quarter last year to 204 million, 205 million nearly, and it almost double on the 9 months. So yeah, interest is increasing rather a lot. As I say, everything's fine as long as the tenants are there. American Tower sort of seemed to be bucking the trend, looking quite a bit better than the others. Sort of revenue up, and all the usual sort of REIT things are up, which is sort of largely just because of dilution. You can't quite count that. Net income down from sort of revaluing, writing things down. Adjusted EBITDA up 10%. But then the important stuff, adjusted funds from operations up 9.5% and per share up 9.3%. So they're not diluting super heavily, and 9.3% on AFFO. VICI did a little bit better than that, but didn't expect to see quite such a good number from American Tower. So that was quite nice. Free cash flow up, capital expenditures down 12% from last year, so not too bad. Dividend sort of 162. Again, sort of don't really look at that all that much. Guidance wise, they're raising guidance across the board pretty much, so that's good to see. Adjusted funds from operations per share up 9 cents, so that's nice. Not a huge raise, but you don't expect huge raises in this sort of market. Even a small raise is good to see. So just come straight onto the balance sheet. This sort of terrible layout of their balance sheet. I don't understand why it can't be any better than this, but yeah, cash slightly up, 2.1 billion. A little bit of restricted cash as well. And then liabilities, they don't really show it sort of particularly well here, but they did break it out above as 38.6 billion in total debt, which is a hell of a lot compared to 2 billion, just over 2 billion in cash. So yeah, that's not something that I like to see, and sort of is main reason I wouldn't be piling into the REITs at the moment at sort of current interest rates. It's a bit easier when interest rates are low, but yeah, I just would rather that debt wasn't there, and maybe they just took the hit while prices were better and did dilution instead. Sort of, it's a harsh pill to swallow then, but they'd be a lot better off now. Interest expense was 294 million this quarter last year, up to 360, and on the 9 months sort of similarly up, and this will carry on up in the next year. So yeah, it just eats into profits where you could have just took the hit, and they were at sort of 25 times funds from operations at one point, price wise, so could have done a bit more dilution instead of taking on more debt. But there you go, that's what they all do. And then just looking at the news for the week, we've had a little bit of UK employment numbers, similar sort of to the US, how they've been coming in recently. Claimants for unemployment benefit up, but unemployment or employment change is down, but a little bit better than expected. 82,000 jobs down. Was sort of expected 200,000. Unemployment rate is actually down. So yeah, not really sure how you square all of these, but I never entirely believe the numbers. The sort of US housing seemed to be pretty much as expected. A little bit worse, but sort of as expected, basically. New home sales were up, so people are buying new houses rather than sort of buying existing and having to sort of remortgage, I guess. Maybe they're buying with cash. Thursday had the EU interest rate meeting, and they kept the same, sort of as expected. They're not really that high. They're not as high as UK or the US, sort of 4.5% on their main rate. So yeah, that's interesting. You had sort of durable goods orders in the US were quite high. And sort of a lot higher than expected. GDP as well, provisional number. I would sort of take this with a pinch of salt. It could get revised down, but 4.9% annualized on Q3. So that's a high number. 2.1% last quarter. So yeah, we'll see if that sticks when the real numbers come out. And yeah, pending home sales a little bit better than expected. And then the PCE sort of official inflation numbers that the Fed look at were sort of near enough all as expected, which sort of has barely moved. Core PCE barely moved from 3.8% down to 3.7%. Same on the monthly. Sort of standard PCE stayed exactly the same. And yeah, slightly higher on the monthly, but all that sort of you'd think points to certainly no rate cuts. I think most predictions seem to be saying this coming week, I believe the interest rate Fed decision, people are saying they'll hold, and a lot, I think it's 80% that they will hold in December as well. So that would mean we've probably seen the last hike, but yeah, don't know with these numbers whether they might sort of try and squeeze in 1/4%. So let's see. So no changes in the portfolio. Still kind of sort of keep looking at this £8,000 in the money market fund, wondering exactly what to do with it. I don't really sort of tend to put many of my sort of main holdings from the invest account in the ISA. Sort of keep this more for gold and silver and the crypto stuff and sort of big growth things that I would, or you know, what I'm hoping will be big growth things, and haven't really seen sort of anything that I was itching to buy. So yeah, it stays there, just sort of earning 4 or 5% a year, which I'm sort of happy to leave there, to be honest. I mean, as I say, I'm not really looking to pile that into REITs, even if they are a little bit cheap, just with the high interest rates, but we'll see. No other sort of changes here. No changes obviously in the IG account. That's just sort of bumbling along, not really moving overall sort of portfolio value. And the Interactive Brokers account, Chinese tech, sort of stays pretty much flat all the time. But the options are a little bit volatile. So Coeur Mining has sort of come down a little bit from last week. Equinox down slightly. Himax is up because I've been buying quite a lot of it. That's all I've been buying in the last week. Just thinking that looks really good. I've been putting some low bid buys in and they've been filling. So I just keep buying. I believe earnings are out in 2 weeks. So yeah, maybe they'll be terrible and the stock will crash, and that's why people are sort of not wanting to hold these options, and sort of whether they're selling them in the market or selling new ones. Yeah, if the stock does well, that may be my sort of last opportunity to be buying these options. But I really like the look of Himax at the moment. CleanSpark sort of is, I believe, slightly up from last week. Bitcoin sort of been really doing quite well, as you'll see tomorrow if you tune in. and Fortuna is still sort of a very small position. So overall, 8,187, but I have been sort of buying a little bit more. So that's, I think, down from last week, even though I'm buying more. So we'll carry on. I may have a little bit more to add shortly, and I actually have £2,500 in cash, sort of still wanting to add more to these. So I would still like to get this up sort of over £10,000 ideally, but we'll see. So leave your thoughts in comments below, and like and subscribe. See you soon.